Okay, so today we're going to take a look at retirement and estate planning. And just think before you retire, you're going to have to make sure that you're ready to go. And some questions you need to think about is how much money are you going to need every single year? Are you going to keep the house, or are you going to sell the house and take the sale money from that and then downsize and then take that money and use it for a part of your income? What type of investment strategy are you going to choose now that you are retiring? What kind of insurance are you going to need? And then are you going to be able to do all this by beating inflation? So if you're not going to make any new money, your salary usually is something that would beat inflation, but your income that you have on things is likely to be more static and not likely to go up a lot. So trying to see if you can invest and also retire is a part of what you need to be worried about. So there's things that you can do while you are working to make it so that you have some money when you retire, and we're going to go over a couple of those. Um, we'll take a look at individual retirement accounts. So there's a traditional one, and there's the Roth IRA. The difference between the two of them is just when it gets taxed. That's basically the difference between the two of them. If you're going with a traditional traditional IRA, you're taxed as you put. You're taxed when you cash out. So you put money in, and you don't pay any tax as you put that money in. So you put in $75, and you don't pay tax at that moment. Later on, you pull out the $75, you get taxed on that money. In a Roth IRA, the contributions are taxed as you put the money in. So you put in $75, and you're going to have to pay tax on that. When you pull it out later on, let's say it was ended up being like $50 that's left over after tax, you pull out $50 and you don't pay any tax at that point. The reason for the difference is really where you think you're going to be in terms of the tax bracket. If you think you're going to be in a pretty high tax bracket after you retire, then you might want to do a Roth IRA, because maybe it's going to be higher in a tax bracket than when you actually earned it. But if you think you're going to eventually, when you retire, be in a lower tax bracket because you earned less money at that point, then it's better for you to pay taxes on it when you pull it out, because you'll get taxed less in the end. So it's basically a tax game. Which way do you think it's going to work? But ultimately, they're both, you're putting the money in, and it's not tied to an employer. It's just money that you've decided to put in. You move from company to company, but the traditional IRA and the Roth IRA travel with you no matter what. Doesn't matter who you're employed. You could actually not even be employed and do this. Then if you want something that's going to be tied to your employer, you could have something at your place of work, like a defined benefit versus a defined contribution plan. So defined benefit basically means that the company is putting in money for you. And then at the end, you're going to collect money at the end. That's what we call a pension. So teachers, for instance, in New Jersey have a pension. The employer makes some contributions. And then actually in New Jersey, teachers also pay contributions. And then after a certain amount of time that you have been teaching, you become vested, which basically means that when you reach retirement age, you could then collect. If you only work 5 years, you can get the money that you put in, but you don't get it as later on when you retire. So if you do work 10 years, you become vested, and then you can collect later on. You can leave the profession after that. You can go to the 11th year and then go like, I'm done teaching, but you can still collect when you turn 55 or some other number that you can retire at. This is a really rare type of contribution. It's defined benefit. Pensions don't really exist in America anymore. There are very few jobs where that actually takes place. Most of the time, you're going to work in a place where you'll have a defined contribution plan, which basically means that you contribute, not the employer. Some places might have matching, where like you put in $10,000 a year and they put in $10,000 a year, something like that. But not all places will have that. So the default basically is that you put the money in, and it's tied to your workplace. So you can get a 401k, which would be for people working in private industry, or 403b, which is for people that work for nonprofits or government institutions. Things like teachers would do 403bs. So you receive the money when you retire based on your account balance. And you might have an employer that would contribute and might not. So what's the difference between 401k and 403b? The biggest difference between the two of them is that the 401k is from employees who work for a company that operate for a profit, so a private company. Whereas 403bs are for companies like a nonprofit or a government entity, like teachers contribute if they want to a 403b plan. The rules are basically the same. The characteristics of it are that employees, like the people working there, contribute a percentage of their wages or salary, depending on how they're paid. And it's done through their payroll deductions. So they contribute a certain dollar amount, let's say, and every single month they have $100 taken out of their pay, or they usually get probably paid bi-monthly. So 2 times a month, their money would come out. And then they can make investment choices within that plan. They could say they want to be really aggressive and go after riskier things and hopefully get a higher amount of money in the end. That can happen. Or they can pick other things. They have different plans within whoever's, managing the 401k can help you, guide you through that. And then you have matching contribution plans that could take place where like you put in a certain amount and your employee also decides to put in some as an incentive to get you to work there. 403bs, basically the same as 401ks. I would say the bigger difference, the only major difference between the 403b and the 401k, other than like the fact that you can't get a 403b if you work in a private industry, the 401ks probably are much less likely to have matching funds. Usually if you have a 401k, they match. I've never heard of a 403b and like a nonprofit organization that matched whatever you put in. I'm sure it happens. I just don't know of it. The next thing to think about is when you die. You don't want to think about it, but it is literally the thing you should make sure that you take care of the earliest. You want to make sure that your goal really is to make sure of 2 things. One, that everything goes smoothly when you pass. And number 2, that you minimize the amount of taxes that you pay, like the people who are going to inherit your estate. The estate is considered, it's got a fancy word for basically everything that you own. Plus, you have to keep in mind that it's going to be minus all of the debts that you have. And it's, of course, at the time of your death. The estate planning is the process of preparing what to do, of transferring that property to someone else when you pass. So there are ways that you can write this down and make it really formalized. You could do the worst thing you could possibly do, which is a holographic will, which you write it by hand, but it's really not valid in too many states. So don't do this. That's what they call a handwritten will. You could do a simple will. A simple will is just a short document of who you want your heirs to be and how much you want them to receive. A will, which you're probably really thinking of, is like a formalized document that tells an estate how it's going to be distributed when a person's dying, when a person's going to die. And in it, you're going to have a person who's going to execute the will. So maybe it could be someone that you're close to, usually, and they're going to carry out your wishes, not just, there are lots of things you could write in a will, not just related to finances, but like where your ashes are going to go or where you're going to be buried, what the funeral is going to be like, plus all of this financial part, which of course we're more concerned with. So go with the will and skip the other things. When people die and they don't do that, like they don't actually have a simple will or a holographic will or a will, then they become intestate, which basically means that the property goes to the state. So you don't want to make it, you want to know, at some point in your life, you're going to need to write a will. So that way this doesn't happen if you were to die suddenly. You want to make sure that the money would go not to the state, but to the people you want it to go to. And then finally, you can modify parts of a will, but you can't just like go and find the will and like cross things out and assume that it's going to be legal. You have to have what's called a codicil. And a codicil is a legal document that modifies parts of a will and reaffirms the rest. So what you do is you don't actually cross things out in the will. You actually write in almost like amendments to the bill, to the will, and they call those codicils. So they don't get like they don't re- they don't physically go in and cross things out. They just add a new document that says certain parts of it are not um, going to follow anymore if you want to get rid of things, and then there's going to be new things that are going to be added in. Like if you wanted to leave some money to your pet, you could do that with a codicil. An heir simply is the person who's going to inherit the money, and usually there are people that are like a spouse or a child or something. The thing that you want to be careful of is to kind of make sure you don't have to pay too much. The people who inherit your money or the heirs don't have to pay estate tax too much, which basically is a tax on property transferred from an estate to its heirs. So it's paid from the assets of the estate before you get the money. So that can happen at the federal level. It can also happen at the state level. The state inheritance tax is imposed on heirs, and it varies state by state. And the percentage can be vary also by relationship. For example, in Pennsylvania, money inherited by a spouse is not taxed. So the spouse doesn't pay for it. A transfer to a lineal descendant, such as a child, is taxed at a rate of 4.5%. Transfers to siblings are taxed at 12%, and anybody else must pay 15%. So that kind of gives you a sense of how you get taxed and how it could work out, and in particular, how it works out in Pennsylvania. While the person's alive, there are things that you can do to kind of spend down the money so you don't have as much that you get taxed later, and what they can do if they anticipate their death or that they believe that they're just getting older. They could, over many years, start to give out money. And you could do this at the rate of $15,000 in 2021. And I think you can go up to $4.5 million over the lifetime. So you can slowly spend down your estate. But if you've got $4.5 million, it would take you a very long time to get to $4.5 million. So generally, you're not going to hit that threshold very easily. It's just mathematically very difficult. And then you may also have to pay a federal state income tax. So taxes must be made on your income for that year. So the executor or attorney representing the state is responsible for making sure that is settled. So there is how all this works out. So today we took a look at retirement and estate planning.